Good afternoon, ladies and gentlemen. It's June 13th, Friday the 13th. Ooh, and the markets were down today on some more geopolitical risks that continue to rise. I just got back from vacation, so I haven't posted here for a minute. We're going to talk about, we're going to recap what we've been talking about and kind of revisit those charts because we've been preparing for this to happen, right? We didn't know what was going to be the catalyst, but we did see that the reward to the upside was minimizing while the risk was increasing. And yeah, we only had a little bit of a down day. Nothing too big right yet, but we still hit this dangerous turning point, and I'm going to be revisiting that with all of you and preparing for not what I expect to happen, but for a potential path of price to be prepared for if it were to occur, because I like to get ahead of it. That's what we do here. I like to get ahead of it and prepare people before it's obviously too late. So let's go ahead and get into today's show. All right, people, welcome back. We're going to start off here with a market snapshot. We're going to hop into some of the divergences. We'll get into some of the intermarket charts, the market conditions. We'll go into some index products, expected moves, and then obviously what's on deck for next week as well. There's going to be timestamps in the description below, and we have a couple pinned comments there, or a pinned comment with not a sponsor, but my partner, Interactive Brokers, and then also the Discord community if you want to check that out. Okay, so first and foremost, how did we fare for the week? The week, right, was rather flat for the SPY. It was down 36 basis points. Qs was down 56 basis points. Week to date for IWM, down 1.42%. So overall, not much movement taking place from a week to date basis. Now, today you can see we saw some sell side activity. And if you look here, it tells a little bit, better of a story. This is the 11 sectors that actually make up the S&P 500. And we're looking at 1 week performance. You can see up here, energy led the way. Now, if you remember the last few shows that we've been talking about, what happens when energy outperforms the S&P 500? Well, bad things can happen. We'll revisit those charts. Take a look at today's price action. Energy was the only one of the 11 sectors that were up. Go figure, you get some geopolitical risk. Oil shot off like a rocket ship. Energy stocks are typically stronger correlated. It only finished up 1.74%, but there was a time where it was up like 5 to 6%. Other than that, you have healthcare and utilities up here too, more defensive type sectors. And then towards the bottom, you can see that tech got hit very hard, and then financials also took a big beating there. If we take a look at seasonality, this chart was posted by the Almanac Charter, Jeffrey Hirsch, and you can see in July, we're rather flat, and you kind of go through this little trough here before you start to pick back up. And this kind of downwards pressure, flattening to downwards pressure from a seasonality perspective, dating back from 1950 to 2021, this is post-election years, typically lasts into and around June 23rd to June 24th and coming out right around June 25th. Now, things always change. Things are always different. You can use this as a potential guide, but I'm just sharing with you because it is showing that for terms of seasonality, we do typically see some weakness around here. Now, we've been talking about many divergences that have been building, and now I'm going to rebring these up and show you what they look like now, because now I'm looking for, obviously, the flip side to happen, right? So for example, we've been talking about the NASDAQ bullish percent index and how it was moving higher, and we had a negative divergence that was brewing, and it's still playing out at this current moment. You can see we kind of moved back down slightly here, and this will at some point in time come back to an oversold condition, right? You can see overbought, oversold. This is just what happens. So what I like to see is just like I saw here, but more from this perspective down here to occur. Now, I don't know when that's going to be or how it's going to happen, but that is one thing that I'll continue to watch for and we'll bring up on this show. But I'm still pointing out the fact here that we've had that bearish divergence that's been building, and now we're seeing a little bit of a come to fruition. You can see the bullish percent index for the NYSE, also a bearish divergence. We had matching highs right here, something that we've been talking about for a while to wait to see if that were to occur. And you can see the market here, NYSE was down the 1.53%, and it's still, rather, high reading. So this can still come off a bit here. We've talked about the breadth divergence here between the stocks, the S&P 500 and the stocks above the 50-day moving average and the 200-day moving average. You can see as the market was pressing higher, we weren't getting higher readings of the amount of stocks above the 50-day, which just indicates that we have some internals weakening. And the same here with the 200-day. We had a subtle divergence here as well as the market pressed higher. We had less stocks above their 200-day moving average, and sometimes those resolve to the downside. This is growth versus value, IWF versus IWD, and we saw a little bit of a divergence taking place here. And then also here on the 10-day rate of change, we still haven't crossed down through zero, which could also be a sell signal in of itself, but the Qs have been pressing higher, and sometimes we've seen these divergences play out where we see some sell side activity in the markets. We also talked about the equal weights not quite measuring up to the cap weighted. So equal weight was going down while the S&P 500 is moving higher. We've seen divergences like this build over the course of time and resolve themselves lower. So we'll see if this breaks in the near future or if it leads to something bigger. I don't know per se right now, but that is something that has been warning us to just careful, right? Be careful. The housing index has been a pretty big kind of flashing signal over here where we had the housing index putting in a lower high, S&P 500 putting in a higher high, and you can see multiple times we've seen these divergences build over time, both positive and negative. And you can see this big, huge recovery. The housing index is nowhere to be seen, right? We put in the higher high even more recently here, but a lower high right there. So is this going to resolve itself in the near future? We shall see. But right now, it's giving us indication that, well, we're hitting these dangerous turning points potentially. You can see the NIMOT, the Nysey-McClellan oscillator. We've had this divergence building over here, even over here where we saw a pullback, but it's still building actually as we're pressing around that 20,000 marker. We're below zero right here. So this divergence is rather large here too, like the ones we've seen here. And well, all throughout the charts, you can see these divergences we've been tracking for years. Okay, so those are what we've been talking about. That's what's been preparing us. That's why for a couple of weeks now, it feels like we've been saying, all right, just when we see an upside day, start to, lock in some profits. That's what I was doing. And then only pay attention to the various stocks that are setting up very nicely, that have a small risk to potentially good upside reward. So let's hop into the intermarket stuff, and I'll conclude more towards the end of the video, my thoughts on what I'm doing. You can see here, we've been talking about the energy outperforming the S&P 500. So when this line goes up, it just tells us that XLE is outperforming the S&P 500. And last time we talked about it, it was kind of wedging in here, and we saw it break out. And what do we see here? The market's kind of coming in a little bit as this breaks out. So in short, if energy continues to outperform the S&P 500 by a wide margin, this line goes up, which means what? Well, throughout history, it suggests that the S&P 500 could stall out, consolidate, and or pull back. And you got to understand that rising oil, right, has never been necessarily a good thing, right? A lot of people will look at it and say, hey, it's inflationary. Some, other people will say it's deflationary. And I'll look at the chart and say, well, when we have seen a massive rate of change spike from like a monthly time frame, when we're looking at a yearly rate of change, you can go date back all the way to the oil embargo, and you can see it's actually never been a good situation when you have a rapid change in price in oil. You can see over here we spiked up, 1987 crash, 1990 crash, the dot-com bubble, the financial crisis. Over here was Russia-Ukraine war, right? And peak inflation. And where are we now? Well, we're nowhere near this. This is a longer term chart, but it's early, and that's why I'm bringing it up, because we just saw oil absolutely fire off like a rocket ship with this geopolitical risks. And yeah, this is getting frothy. I don't know if it's going to consolidate and continue up higher. Is this bad for the economy? I mean, where it's at right now, rather just kind of just going sideways over here, right? So it's not really moving all too much. But if this thing were to creep up into the 80s, 90s, 100s, and yeah, that's going to be some problems. If we take a look over here, the 10-year yield typically tracks oil quite well, and the 10-year yield was up today, you can see, but oil has made a massive, massive move, and the 10-year yield is rather just kind of chopping around here overall. So question to me here is, hey, if oil's going to hold up and continue to trek higher, is the 10-year yield going to follow this same path it's been on and continue its move higher? And if that is the case, well, we got to look at what's correlating to the 10-year yield, as well as obviously the dollar. So you can see over here, the 10-year yield, the price momentum oscillator is kind of just going down, and then we have this action just kind of consolidating sideways. TLT was down today, which this is also interesting to me because geopolitical fears have been rising, but we haven't seen this like TLT being a flight to safety or flight to bonds, and that to me is a little confusing, right? On a move like what we saw, you'd see that we'd see kind of a rush into some type of safety, and we just didn't really see that here in bonds. So I think we're going to have to kind of monitor this moving forward a lot closer. If you look at the dollar, the same thing, right? The dollar was rather low today, not moving much, and another thing that you would think that potentially could create some sort of a flight to safety type trade. Now, I will say this, it still may happen, but you have this low, this lower low, you have this low over here, and then you have this higher low. So we do have a positive divergence here. So if the dollar were to all of a sudden find itself to move back up to around 100, the trade weighted dollar, and even the 10-year yield stay where it's at or move higher, that's not necessarily going to be a good sign for the markets. And I'll show you kind of why that is. So on this chart, we have the dollar, the 10-year yield, and the S&P 500. And at times when you see, various kind of economic environments where you see a rising dollar and rising 10-year yield, it's not been good for the S&P 500. So you can go back over to here in 2024, the dollar was falling, the 10-year yield was falling all the way October. What was the S&P 500 doing? Well, it was ripping. Then it came into a period where they kind of went into this correlation, and then shortly there started breaking again where they both went down, but the S&P 500 went up, the US dollar went higher, the 10-year yield went higher, the S&P 500 stalled out, the dollar was down, the 10-year yield was down, the S&P 500 went higher to an all-time high. And then all of a sudden we started having problems over here. We went into negative gamma and we started to see some big volatility take place where everything kind of lost its correlation. The reason why I'm bringing this chart back up now is because I started noticing in the very short term, what do you notice? The dollar falling, the 10-year yield falling, and the S&P 500 is up. So what does this mean? It means that if the 10-year yield follows oil and starts to move higher, if the dollar potentially presses higher from that positive divergence, is the S&P 500 have more room to go lower? And you can see that here on these correlation charts. So this is the 10-year yield and its correlations, 20-day correlations to the S&P 500. It's negative now. It was positive, and we were talking about that when it was positive. Over here, the NASDAQ, negative. The IWM, negative. Bitcoin is actually still positive. Housing index, it's kind of neutral. And then also China is also neutral here too. So this right here is an important one to pay attention to. But then the dollar, take a look here. We were very positively correlated on a 20-day period, but what do you notice happening? The dollar's now negatively moving to a negative correlation with the S&P 500, negative correlation with the NASDAQ, negative correlation with IWM, negative correlation to the emerging markets. Positive correlation to Bitcoin, actually, surprisingly here. So maybe Bitcoin's, could be a saving grace here, perhaps. But I forgot to actually add a chart about the Sailor to Shift tool, but it did cross down through zero. The week didn't close yet, so we could have technically a sell signal, but I still wait for the official trigger. So I'll talk about that in the Discord. I'll post it on Twitter for you, okay, or on X. And then China down here is more of a neutral, but I put red, probably more neutral than anything on the dollar. So what do I mean by all this? It means, simply put, watch what those assets do because they are starting to become negatively correlated. So if the dollar wants to move higher, the 10-year yield wants to move higher, or maybe the dollar wants to make a big move and the 10-year yield paws out, that actually could be a potentially unhealthy thing to take place from a shorter term perspective here by looking at these specific charts. Now, let's view market conditions. Market conditions are incredibly important. I'm going to revisit this because we talk about it on every brief, but most people have a trading strategy, but what they don't understand is, they'll be like, my strategy worked really good here, here, and here. And then all of a sudden, something's wrong. It's just not working. So they go look for something else or whatever. And they fail to pay attention to market conditions or have a way to gauge changes in market conditions. Or even deeper, they don't understand what strategy that they're using, what environment it works best in. So in market conditions, there's two things I look at: the gamma flip line and the directions of the 5-day moving average. Now, the gamma flip line is of utmost importance because it tells you how dealers start to, how they hedge, right? It has to do with dealer dynamic hedging. And I'll walk you through that when you get to see the visual of what it looks like when we're above the flip line or below that gamma flip line. And I want to talk about a couple of other things here. The VIX futures curve you can see currently is in contango, but hardly, right? We're down here at 21.65. The next month out here is at 22. So we are in contango, which means, we see problems out in the future. This is normal. This is what you want to see. But in all reality, from 21.65 to 22 to the next month, this is pretty flat overall. And I wanted to just kind of point this out simply because if we go into backwardation, this is typically where some gnarly stuff can happen. And this right here, it's starting to flatten out, and it's happening while we're seeing the volatility start to increase, getting above some pretty critical levels that a lot of hedge funds, institutions pay attention to on the VVIX. So this is starting to take off and even gave us a warning shot here more towards the beginning of the week. If you look at skew is picked up too. So between this and this, what are we seeing? Well, we're seeing hedging activity start to pick up a bit more in the S&P 500. If you start to look at back month versus front month volatility, we didn't quite get to 0.20, which means back month is 20% higher, but we did reach up into an area that says, hey, we could potentially stall out here, start to consolidate, and then when it drops into these areas down here, we start to look for bottoms of some sort or bases to form. So that's the update there on volatility. Now here's the gamma flip line. The current gamma flip line is slightly below where the price action closed. So it's like right under 6,000. Price action's been getting very tight. We were saying, hey, how this kind of looks similar to over here where we saw this dip, it consolidated, broke out to a high and then sunk down, right? We came down here, we consolidated, we broke out to this high, and then we started to pull in a bit. And as price action was moving higher, we were saying that, 6,000 being the call wall, which is, an important gamma strike, which, by the way, we have a roll taking place this next week. So we'll see what gamma looks like coming out of that. But as we were pressing up here, we were, for the SPX, right above us was the upper quarterly expected move and upper monthly. And so we started talking about what? We started saying, simply put, that we're pulling into an area where the reward to the upside is minimalized. So if you're going to approach the markets, make sure you're looking at names that are tightening up where you can see very clear defined risks, but also just be very careful as far as, oversizing positions or getting too heavily weighted when this kind of stuff happens. Okay, so overall, this right here is the gamma flip line. That's kind of where we're at. I'd consider this gamma neutral. Now, why did I say that this is so important? The reason why it's important is this chart. You can see here, when we're this darker blue, we're a negative gamma. When we're here, it's a positive gamma. And what happens when you fall under the flip line, right? This is being under the flip line, what it looks like. And where are we now? We're right there, not too far off of it. This is what the VIX looks like when you fall under the flip line. It's those gray boxes. What does this tell you that dealers are doing? Well, hedging activity goes like this. When you're below the flip line, you get selling into selling, you get buying into buying, which means volatility typically increases, liquidity dries up, okay? During the times that we're not in the gray boxes, what do you see the VIX doing? You see it going down. Why is that? Well, because dealers then start to look to sell the rip, buy the dip, sell the rip, buy the dip. That's where volatility typically comes in. Liquidity typically increases. So the reason why I'm calling this out now is because we're kind of on that frothy line right there, not quite under it, but if we start slipping and the dealers start selling into selling, this is that very, very dangerous turning point. And I want to be very clear here. You know what this day was right here? That was February 21st. And February 21st was, I think, right here, what kicked off a bunch of sell side activity. So you get to visually see what that volatility looked like. Now, when you're in negative gamma, right, we talked about various strategies. When you're in positive gamma, when you're above the flip line, I typically like to focus more on swing trading. Now, when we're below the flip line, I like to focus more on day trading or shorter term trading. Now, with swing trading, I like to play breakouts where stocks are getting tight. Boom, you play the breakout or you speculate inside of it, and then bam, you play it out. Now, when you're in negative gamma, this strategy, it doesn't work nearly as good because you get a lot more fake outs, boom, whipsaws, shakeouts, and you get a lot more failed attempts to really get any momentum trading in a negative gamma environment, thinking that this one works better. Now over here, if I'm swing trading, I'm doing more significant fading activity where price action fell dramatically in an individual name into a key level, and then I might start small positions to fade for the potential bounce move. So I trade it a little differently there when it comes to swing trading. And swing trading for negative gamma would be more like, 1 to 3 trading days, maybe a couple more depending on, how good it goes. It doesn't mean that I'll stop, from taking a good looking setup, right? If something looks really nice. But if I were to take a nice looking setup from a swing trading perspective in a negative gamma environment, the position sizing is going to be cut dramatically given the context of the conditions of the market. Then when it comes also to day trading, I also do a lot more intraday trading. I get a lot more opportunities from an intraday perspective. More on that subject, obviously, at a later time. The next thing that I like to look at is the direction of the 5-day moving average. So we're starting to get some red over here, meaning what? It means price action's below the 5-day moving average, synthesized 5-day moving average, right? We're looking at 30-minute time frames with the 65-minute SMA. It's basically the synthesized 5-day moving average in an intraday time frame. And this means that price is below it and this is starting to curl down. So it tells us one thing. It tells us, hey, caution, warning, careful. This could be the start of a potential change in trend. So if you're a patient trader, you want to see this back above, you want to see this start to inclining again see it, start to base out for a while, this to come down more and so forth. And then you could find better setups. And that's happening in the SPY, the Qs, the IWM, the DIA, the XBI. Semiconductors is yellow, and yellow just simply means price is right now below it, but it's actually trending higher, the 5-day moving average. But if we stay down here, obviously that'll turn back around. So we have a couple of warning shots, right? We're right on that gamma flip line, right on the brink of it. We're starting to see price action fall below declining 5-day moving averages. So it's a time to kind of just pump the brakes and see if the market can heal itself. And once again, like we're going to hop into the index, just show you kind of an overall thing. We'll talk a couple more things and I'll kind of just share with you what my portfolio entails right now. Okay, S&P 500, we're only down 39 basis points on the week. For everything that's happened and occurred, that's really nothing. So if we start to slip off, maybe look for a reconnect again at that weekly inclining 5-period EMA, which is roughly at about 5,900. We did happen to tag it last week, but it tagged through time, not through price. So time being above it drew this in further. If we take a look at the daily time frame, you can see we've been getting very, very coiled up and tight. We finally saw a little bit of a break here in the S&P 500. Is it the start of something big? Maybe, but I wouldn't be surprised if we see it bounce back up. Everyone gets super excited and then it does something like that again. So we got to be prepared for multiple situations here. One thing that I did find interesting is there are shorter term divergences on the 15-minute chart, which will update you on those expected moves and so forth. But you do have a higher low on the RSI, you have lower low in the reading, and then on the price momentum oscillator, you do not have that same situation. So if for some reason we start to bounce up higher, pay attention to where the 5-day moving average is and maybe where, last week's week-to-date average is, anchored volume weighted average price, because it could be hiding right at around the 600 to 601, and it could act as a potential level of resistance for the S&P 500. The NASDAQ 100, you can see we've had that negative divergence on the daily time frame, and now it's started to play out one single day over here. If you actually look at the Qs and how it's been kind of going up but seeing these down days, you've actually seen some distribution days building where you see pockets of red volume kind of spike higher as price action just slowly grinded over here higher. You've seen some big pockets of distribution, and when you start to see that, it could resolve itself, and we'll look back in hindsight if the price action wants to come off a bit. We'll look back in hindsight and be like, oh, it was so obvious. We had distribution building, right? Let's look at the expected moves. If we take a look at the SPY expected moves, the blue right here is the quarter to date expected move. And well, we started our quarter right here. We busted through the lower quarter to date expected move. And this is typically where many times, if you're a longer term investor and you get hit to under the quarter to date expected move in a short period of time, it's a good time to add some exposure if you're one of those, buy and hold, for retirement or whatever the case may be, if you have a long time horizon. I've noticed that to be the case. But what's so impressive here is we came up very fast. We came back and kind of back tested that level. And then boom, we've came all the way up and we tagged it basically to the penny, the upper quarterly implied move. So overall, price actions quarter, right? The quarter ends in June, and we knew these levels. We knew both of these levels at the end of April. Sorry, not the end of April, the end of March. Going into April for Q2. Now for the month to date, that's the purple, right? The purple's here. We came up close to it. We didn't quite get to it, at least yet. The other portion there is at 564.50. So if we want to come all the way down here into June, in June, that would be well within its market's expectations as well. Going into next week, we have about a $10 expected move. This week, we did not tag it, which is a pretty rare occurrence. I think that's the 4th week this year now that we have not tagged it. So next week, I'm probably going to be looking to tag a $10, maybe even more expected move going into next week. We'll give those specific levels on this page. We have 607.24 to the upside, 586.76 to the downside. That is what the market's pricing in there for the week ahead. Okay, on top of that, you can see the 604.83, the quarter to date, it literally tagged it to the penny and then started pushing from those levels, getting underneath that week to date VWAP and that declining 5-day moving average. So that's why I said, if we start to see this market bounce up, pay attention to last week's week to date VWAP, and then also the declining 5-day moving average. When we come into Monday's price action, the daily implied move can bring us up to and around 604 to 605-ish to down here right at about 589 to around 590 at the time. On deck for next week, we do have the Fed interest rate decision. So we'll see how they're going to respond to all of this, what's going on, if they're going to be looking to cut rates, when they might look to cut rates, because they're going to be giving us those projections and the interest rate decision, and then we're going to listen to their press conference. I'll try my best to do a live stream. I don't know if I'll be able to. Overall, people, we talked about a lot of stuff. To recap it, we talked about the divergences that have been building and how they haven't fully played out yet, but they started to play out today. Okay, and they have a long time to start to get to more of a oversold condition. We talked about intermarket stuff that's been taking place, the dollar and the 10-year yield, and how they're starting to positively correlate. So those are going to be important to watch. We talked about how the market conditions are starting to change, right? The dangerous turning point with the gamma flip line. Where's the gamma flip line? It's right around here somewhere. There we go. The gamma flip line, we're right on the edge of maybe going negative gamma, which means that we typically can see volatility increase. We saw a little bit of a pop today. And then we talked about the various expected moves. What I want to tell you now is kind of how I've been just navigating this. And we've been talking about it, right? So we look for, once again, the strategy that fits the best market conditions. So if we slip into negative gamma, I'll probably focus a lot more on shorter term trades, shorter term fades, and if the setups show up, if the really good, tight, price action on a various stock or equity show up, I might take it, but it's going to be reduced position size. As it stands right now, as it stands of yesterday, I was actually 70% in cash. And today, that actually increased slightly more. I've been given the kind of the opportunity here to be in a little bit bigger of a cash position because I've been managing quite well of about 30% year to date, 29 to 30% year to date. And that's, giving me the opportunity to kind of step back a bit. And if the opportunities come back in and they show up, I'm for sure going to be pressing my buttons once again. I hope today's episode helped out. I'll see you on